everyone. If you have time or if you have the ability to turn your cameras on, please do. Turn your cameras and mics on. Say hi. We want this to be interactive. We want this to be fun. JJ, am I sharing? I forgot. Am I sharing my screen right now? It's not showing the little thing right now.
Yep, you are.
All right. Fantastic. Notch.
Can you hear me?
Sure can. How you
All
doing,
right.
buddy?
Yeah, Zoom screwed me up here. All right, I'm doing well. Good to see you. Look
Good,
forward to
good.
seeing what you got to say here.
Yeah, good to see you too. No, we're just So we're basically we just started doing these a month ago, and we are basically just doing this a once a month call with a different topic each time, just as a way to network with each other and learn and talk. Discuss a topic, answer people's questions about how commercial real estate investing and investing through syndications works. And just a way to have a little bit of fun and get people a little bit more knowledgeable of the process.
Sounds good.
So yeah. JJ, Brett, anything you guys want to say starting off?
I guess they let anybody in if we're talking Navy, and we've got Marines. Oh man, I'm just happy to have everybody. Had some great feedback from the previous last month's webinar, and really trying to dial it in on what it is that people are wanting and interested in. That way we're dialed in exactly where we want to be. And so thanks everybody for joining me. I know there's other things and family priorities and so many different avenues that you could be doing right now and whatnot, but we do want to have the ability to have anybody on camera here shortly, and just get out there and introduce yourself and let us know who you are. And at any time, jumping in, asking questions like Greg had mentioned right there, it'd be great. So thanks again for dialing in.
Yeah, please turn your cameras on if you can. Maybe keep yourselves on mute unless you want to ask a question. Feel free to unmute if you've got a question to ask. Otherwise, if there's kids, dogs, people walking around making dinner or anything like that, let's try to keep that stuff on mute so it's not so everyone else doesn't hear. All right. Well, with that, give a quick intro on who we are. Everyone on here should know who we are, obviously. So Greg Butcher here. I've been doing commercial real estate investments since I retired from the Marine Corps in 2015. I got my company BluSky Equity Partners. Have a deal together. Working on a second one. We'll close here real soon with JJ and Brett from BAB Investments. And looking at potentially partnering up more long term here in the near future. So JJ and Brett, you guys want to introduce yourselves?
Sure, Brett, you gonna go first?
Absolutely. Brett Hadley with Badass Brothers Investments. Just recently attended the Tim Maya event here locally, looking to figure out how we can do this business and scale it a lot faster than what we are currently doing, and just have the ability to have folks that are, doing things at a much more efficient and effective way. So we are in the midst of starting a fund so that we can raise capital more efficiently and effectively rather than on single deals. And just excited to be a part of this team here, and being able to impart knowledge on those folks that may or may not. And not only that, just being able to learn from everybody on the call as well. That's one of the key factors in why we wanted to start this, because we were having questions and jumping on calls with several of our investors that just, it would be nice just to get everybody together and let's collaborate and grow together. So 19 years Air Force, so don't hold that against me. But looking at jumping all in here within the year, and looking to grow this business even faster. So thanks for everyone joining this evening. And JJ, I'll let you introduce yourself.
Thanks, man. JJ Hadley here. Thanks for everyone for joining the call tonight. Brett and I, we got our start in real estate kind of like on calls like this, learning, networking with individuals. So we know that there's broad range of spectrum of experience on the call tonight. We got started in real estate in 2019 with just smaller multifamily units. And then we did our first large apartment complex with Greg in Fort Worth. and our businesses just went crazy after that. We've got around 400 units as a general partner now, and like Greg said, we've got another one getting ready to close in Tucson, Arizona. So we just love this business, and thanks for everyone for joining us tonight.
Fantastic, fantastic. Well, we're here, so who else is here? People here are generally either they're generally members of our investor clubs, or people we're acquainted with in one way or another through commercial real estate. So, as members of our BluSky Investor Club, members of Brett and JJ's BAB Investor Club, and then any other guests and others that are here. Feel free in the future too, if you see these registration emails coming out, to invite anyone else that who might be interested to learn more about how they could participate in commercial real estate syndications, or at least learn a little bit about it. Any and all are welcome in these events, so feel free to share them out. That said,
and Greg, I want to jump
Yeah.
in there because I want to share this with the team. This is hot off the press. Like literally, my HVAC guy that was over at my house just now working on my system, 20-year Army vet. He was like, "Whoa, yeah, absolutely. I'd definitely be involved." So he will be joining us on the next call with Berkey's. But in any case, that's the kind of that's what we want to do, is be able to spur that kind of development within our tribe, those who have served. And so, like Greg mentioned there, if there's any opportunity to bring more people in and get them involved, please do.
Yeah, fantastic. That's a great point, Britt. Thanks for sharing that. That said, before we move on I would like to give everyone a chance here to just to hop on real quick, say who they are and what they're, talk a little bit about why you're here, what you're trying to learn about. And I know there's some people with some different varying degrees of experience here on the call. Some people are already involved in syndications. Some people are, and some people are brand new to it. So feel free to unmute yourself real quick and just give a quick little intro on who you are and what your interest is in everything. And also, of course, this is supposed to be a little bit of fun. So maybe what you're sipping on tonight. I got a cup of water, but I also got a Modelo here. So, there's that. Who'd like to start off first?
Ignacio Soria here. How are y'all? Yeah, so I left the Marine Corps in 2015 after 24 years, and I've been bouncing around big companies, small companies, mid-sized companies, started my own gigs. So 9-10 years out of the Marine Corps. I am right now building a division for a company based out of Phoenix, Arizona. But I have an opportunity in Pahrump, which is about 40 miles out of Las Vegas. I live in Las Vegas, and we are there's a shortage of housing there, and it's one of the fastest growing, I guess, small towns in the country, and about growing at a clip of about 15% a year. There's opportunities for I got a team built already, and we've got a full team ready to go to look at building senior housing specifically. We've been looking at subsidized housing. Seems it seems like the subsidized housing turns into projects real quick. So I think we want to stay away from that. We've got good relationships, but we've got investors beyond the initial inject that we need. But I'd like to learn how to make money in this. How I'm getting ready to drop about two grand to have a financial model built specifically for senior housing, so we can see how the money is going to shake out. But yeah, looking forward to listening to your successes, to see where you've gone with this, and I don't know where. It's a big military retirement community as well, Pahrump. So there's lots of opportunities, be they multifamily or single family. There's just something to be had there, and soon enough, in the next 10-15 years, Pahrump will be not a subsidiary, but an extension. It'll be connected to Vegas. I mean, literally. So we'll looking forward to seeing what you guys are doing. Want to learn more. Thank you.
Thank you.
Fantastic, Notch. Appreciate that. I just made a note as you were saying that to make an introduction to you to a good friend of ours who focuses pretty heavily on senior housing these days too. So we'll get that connection here made.
Great, thank you.
Absolutely. All right. Who else wants to jump in?
I can jump in, Jason. Hey, Greg, is my video on? I don't see myself on here.
Yeah, it is. It's on. It's I think it's cutting your head off a little bit, but you got
Oh,
a seatbelt on, but you're
there you
across
go.
the Golden Gate Bridge at the same time.
Oh, weird. Okay, I can't see myself. So, yeah, no, Jason Nicholson, actually out here in Riverside, just about, I don't know, what about 20 minutes or 20 miles north, 15 miles north of where Greg is. We
That's right.
met on another syndication webinar and connected, and months later here we are. So really my forte is underwriting. That's kind of what my value add bringing to syndications and joint ventures are. Right now I'm a part of 3 deals that are underway: New York, San Francisco, and San Antonio. I don't know if you got my email, Greg, but definitely wanted to see what your thoughts were on that deal. It's a $42 million deal, so it's a monster. So pretty excited on that. Entered into learning multifamily about 3 years ago, and still looking to get my first deal myself. But I'm a financial planner by day, so I love my numbers. Just continue to learn and educate myself, network, and build myself to the $50 million number is what I'm trying to get to.
In terms of
Nice.
portfolio size, or in terms of like properties, an individual property size, or in terms of what, Jason?
Yeah, I think the 50 million, that's my I do have my LLC. I don't know if I had that when we had lunch, but my LLC is up and running. Got my EIN. I'm ready to go.
Fantastic.
Money is in the account, and I don't have my key now. Sorry. I was with my daughter this afternoon.
No worries.
That's 50 million under assets within the entity itself. So whether it's 5%, 10% here or there, 100% of a small deal, quicker I
Got
get
it.
up to that, maybe it's a huge portfolio of 500 million to $1 billion. If I'm a 2%, 5% owner, like the New York deal, it's 2.6 million. I'll have a 5% carve out more than likely on that. Maybe a 5% on the 42 million. Hey, and it'll just continue to add up.
Absolutely, that's fantastic.
So.
Yeah, I'll touch base with you separately on the email, Jason. For sure.
Awesome.
I just made a note for that too.
Awesome.
Excellent. Well, glad to have you here, man.
Thanks to be here.
All right. Anyone else want to turn your camera on or unmute and do a quick introduction?
Yeah, I can go next, fellas. My name is Gabriel Soto. I've been on a couple calls already with you guys. Love what you guys are doing. And thank you for your guys' service. I mean, honestly, we wouldn't be able to have any type of, networking or any of this investing stuff if it wasn't for, your guys' service and everything. So thank you for your guys' service. Really appreciate it. And sorry, that's my daughter. We're eating dinner, but me and my wife, we started our business about 8 months ago, and we actually had the opportunity to come in as an LP, or even just even start off as a single family route as well too. So after doing a lot of research and diving into real estate and the different types of investing, we decided that we're going to use what we have, and we're going to start our own business and help others to hopefully get them into multifamily investing and things like that. So 8 months in, working on our first deal still. We've been able to, what me and my wife really focus on right now, we're capital raising, trying to get as much capital as we can whenever the deal comes across the board. We have sponsors lined up. We did take a hit right now. We had an underwriter, but he went down with some health issues. So we are looking for an underwriter right now. So I think Jason was talking about he's good with numbers. So maybe Jason, we can exchange contact information and see, maybe we can partner together or not. But regardless, we're just, chipping out the tree one day at a time, and just jumping on calls like this just to educate myself more and just learn from the best. So that's why I'm here.
Thanks.
Fantastic. Glad to have you here, Gabriel.
And with that, that made a good comment right there, Gabe. Like if you guys could put your contact information so that we can collaborate, that would be awesome in the chat. That way, if folks want to get in touch with each other outside of the call, it'd make it that much easier. So just wanted to throw it out there.
Absolutely. Absolutely. Who wants to go next? We got how about Nash? Nash, you want to unmute yourself or come on camera real quick and say hello? Nash, can you hear me? Oh, he may have stepped away for a second. All right. Anyone else want to pop on just to say hello real quick, or especially if there's anything you're looking for right now for what you're doing, whether it's your business or kind of side hustle or whatever your interest is in the real estate space?
We can go next. Actually, we're signed in under my husband's account, but my name's Hannah. We're actually doing this together. He's putting our 3-year-old down to sleep right now, and I'm feeding a 4-month-old. So we stay pretty busy around here and squeeze these in whenever we can. But we just purchased our first rental properties last week, and we are actually signed up for the cohort starting on the 15th. So we are brand new to all of this, just learning and getting our feet wet with it all.
Awesome. And you said your name was?
My first name is Hannah.
Hannah.
Same
Awesome.
name. Yep.
That's awesome, Hannah. What is that program that you're signed up for to start with?
It's the cohort starting on the 15th. I think it's for the commercial investing, multifamily investing.
Active duty passive income, Greg. I believe that's what you're talking about, Heather, right?
Yeah, you got it. Yeah. With the
Okay, fantastic.
I'm glad you joined us, Heather, and congratulations. Yeah. Like it's not easy being an entrepreneur, and I totally understand. Got a daughter right now with special needs. As if you hear the ticks in the background, that's what you're hearing. So in any case, like I totally understand, and it takes a dream team to make it happen. And so thanks for joining.
Yeah, happy to be here. Thank you.
All right. Anyone else want to introduce yourselves real quick before we get started with the presentation? Not presentation, but really discussion.
All right.
All right. Going once, going twice. Sold. All right. We'll move on. So what are we trying to achieve here is just exactly what you see here on the screen. You know, we want to help veterans and patriots through these hands-off real estate investments. You know, common things we hear are that people are tired of seeing their accounts in the stock market going up, going down, going up, going down, going up, going down, and never reliable over the long term. It makes some money, but it's not a reliable source of wealth building sometimes. You know, that there's some people who are a little bit older and they just want to grow. They need to grow their retirement funds more quickly than they're able to do in the stock market. And then there's others who just are very aware of the wealth building power of real estate, who just don't want to, you know, take the time to be landlords themselves and do things that way. And that's okay. And there's other people who do want to do that, who want to become active investors like we are. And that's fantastic too. So there's no wrong answer for what your interest is in the field. Like it says here, if you're not financially free, we want to help you get there. And if you are, we want to help you end up building a legacy for your families. So,
and just to add on that, it's like one of the best things that just happened to me recently. I was coming down the stairs and my kiddos were playing Cash Flow for Kids. And I overheard my 8-year-old tell my 12-year-old, Ashley, why did you buy that? It's not even cash flowing. And on top of that, her answer was even better. I overheard her say, well, it's not cash flowing yet. And that's what it's about. Like that's when it makes the whole reason why we're doing what we're doing worthwhile. And those are the types of things that I wish I would have known. And had I known, we wouldn't be where we are today. We'd be so much further along, right? And so those are the types of things that we want to do here, is to help our military members, especially some of the people I'm working with right now that are getting ready to retire. They want to step out, and they're thinking they're going to have to go get a W-2. Well, that may be the case. Or have you thought about doing this? And so bringing them in here and teaching them and educating them and telling them and showing them the way that, hey, we want to focus on our families. Like Heather was just talking about, like, hey, you want to have that time, that quality of life, and be able to be there for those moments when your kids are doing those critical things. And that's what we're here to do, is to help make that happen.
Yeah, exactly. 10, 15 years ago, when I was trying to get started in real estate investing, part of my why for why I was doing it was because I didn't want to have to go get a corporate job when I retired from active duty. That was one of my biggest fears. So, if anyone can relate to that, there's a lot of people who've been in the same boat as you, believe me. So, all right. Well, moving on, we'll get to the actual topic tonight, which is how multifamily properties make money. So this is the very basics. If you've been doing this for a little bit, then this is probably going to seem pretty simple for you, but not everyone knows this stuff. And so we want everyone to start off with understanding the basics on how these properties make money. So we start off with the basics, which is the rental income. That's the majority of the income you have. If you look at this little area right here on the screen, you can see it's basically set up as a profit and loss statement or an income statement. You start off with your rental income. That's the majority of your income you have going in. And then there's also something called other income, which is you might also call ancillary income. And we'll show you what that is here in just a minute. Those total up to your total income. And then from that, you subtract your operating expenses to get your net operating income. After your net operating income, and that's a big important number. We'll get to that here in a second, but from that you pay your debt service, contributions to reserves, and a few other things. And what's left over is your net cash flow. That's important because that's what you're able to make distributions with. So all you guys who have done investments before in this kind of property, any kind of commercial property, when you get distributions, whether it be a monthly basis or a quarterly basis, depending on the property that you invested in, this is where those distributions are coming from, coming right out of the cash flow. So, JJ, Brett, I don't know if anything you want to tag in on that real quick.
No, that's perfect, Greg. And that's exactly what I wish I would have known. And right here is, I mean, I hearing in what Greg's about to explain on the cap rate, and understanding how you can pump equity and value into a property is amazing. And to know these types of basic math, but you don't know what you don't know. And so, Greg, that's my 2 cents on that. If anybody wants to jump in and put their thoughts on here, I'd love to hear as well from everybody on the call.
Yeah, when we first started, when we got our start in real estate, we started buying smaller multifamily units. We're still considered residential, just not commercial. And those are completely valued, completely different than the commercial properties that Greg's going to talk about with the NOI. So they go off of a comp of what other people have done and what they've sold for in their neighborhood. But with commercial properties, they're valued by the NOI divided by the cap rate. So you can pump up and increase that NOI as much as possible, and you have control over that, a lot of it. And so this is where you make your money in multifamily is appreciation and putting that money back into the NOI, increasing that. So
yeah, so for us as investors, the two big things that we make money from these properties from is the cash flow distributions, and then the appreciation on the back end. So the cash flow distributions is, that's how we get down to it right there, what I just described. But then the appreciation on the back end is all growth in the value, which is caused by, as JJ just said, growing the NOI as much as possible. That part we do have control over, and then selling at an advantageous cap rate, which that's the part we don't have control over. That part is more like thinking like the comps for single family. It's a matter of what the market's willing to pay for this type of property. So like a couple of years ago, before the rates started going up, the cap rates were lower, meaning the property values were higher. And over the last 2 years, as the interest rates rose from the Fed, the cap rates have increased, which makes the property values decline some. And that's how right now, why we're at this great point in history in this market cycle, at least, to be able to invest right now, while we know that rates are, the prices are down. And over the next few years, even the Fed is saying that rates are expected to decline, so which would lead to further to the cap rates starting to decline again and lead to higher value. So this is how it's done right here. This is what focuses on the appreciation point. Anything else in this slide, guys, before I move on?
Yeah, so talking net operating income, growing the net operating income, are you just talking about rents, increasing rents Is that what you're doing, or are you just maximizing occupancy? Combination of both? You're adding more apartment units to the building. How are you doing that?
Notch, that is a great segue to the next slide. So that's part of what we're going to talk about here. So for a profit and loss statement, at least in accrual method accounting, you start off with the gross potential rent at the top. And this is a little segment from one of our properties showing the gross potential rent. Okay, so the gross potential rent is what your maximum rental income would be if every single unit is occupied 100%, and they're all at market rents. Now, the reality is, not usually all, you're never at 100% occupancy, and also all units aren't always at market rents. You have some rents, some units that might be a little bit lower. You have people who have lived there for 5-10 years, and the increases they've had just hasn't kept up with the growth in market rates. Any number of reasons that might happen. Or if the rental market is weak, then maybe you just can't get your market rents at that point in time. So there's a lot of reasons why a unit's rents might not be at the market rates. The difference between the gross potential rent and the total rental income is what's called the economic vacancy. So that's the difference. And there's several different categories of that. So the most common ones are listed here: gain or loss to lease. Gain is a good thing, and that's what's represented here, but it's positive number of $458. But loss to lease is more common, and that's when if market rents for a particular unit are $1,000 a month, and you have a tenant that's paying $925 a month, then that is a $75 loss to lease for that unit. And so on a P&L, you would see this summed up at the entire property level, as you do right here. Besides loss to lease, any concessions that are offered for, when you see move-in specials, when you see $250 off move-in special, something like that, those are concessions that come off of the total gross potential rent, so as a deduction. When someone either skips out or they're evicted, and they owe a bill still, and that ends up not being able to be collected, then you have bad debt that's written off, uncollectible rent. Okay, so that's a typical loss also. And then last is the loss associated with vacancy. Like I said, there's not 100% of units rented in most cases all the time. So if you have 95%, if you got a 100-unit property and 95 units are rented, then you have 5 units that are vacant. And if those are all, say the market rent for those units is $1,000 each, and that means you would have a $5,000 vacancy loss if those are all vacant for the entire month. So and that's what you see here in vacancy loss. So total rental income is the total amount of rent that should actually be paid during the month by the tenants. Sorry, I shouldn't have left that yet. Brett, JJ, anything you want to jump in on that real quick? And Notch, I promise where the answer to your question is coming, because that's going to be on the next slide, I think.
No, Ignacio, that was a great question, and I think that's why one of the biggest reasons that we are in this business is because there's so many ways to increase the value of the property, and we're going to go in a little bit more in depth on that in future slides. But that's the whole reason we're doing that, because there is so many ways to make sure that we're increasing that gross potential rent. And how can we do that? What is the value add that the business plan that we are going to execute in order to make that happen? And that's why having somebody on your team that is a phenomenal asset manager, such as Greg or my brother JJ, that's why it's so critical that they are there executing that business plan that you stated to your investors. This is exactly what we're going to do, and then we're going to stick to that plan as best as possible by doing some of the things that you mentioned, Ignacio, whether it be adding additional units, modifying other units into other different way of actual, like we had a 4-bedroom, we're going to modify it into a 2-bedroom, 2-bath. And so there's multiple ways to make it happen. And that's what's awesome, is that you just get together prior to actually executing and getting it under contract, is that you come up with this business plan that can push value into the property itself. Does that make sense?
Yes, it does, and I guess it's driven with the renter profile, right? I mean, there's got to be some consistency with rental coming in, so that you can get as close to that GPR, I guess is the way you guys are referring to it as. All right, yeah, I'm tracking. Appreciate it.
Fantastic. Well, besides so this is how you calculate the rental income, and how the total rental income is calculated as a factor based off of the gross potential rent. Next is the other income, okay, or ancillary income. And there's a whole variety of things that can contribute to this. These are some of the most common ones that you see. And in terms of looking for ways to grow income, maybe you're looking for ways to add some of these amenities on the property. Like maybe you don't have vending machines on the property, but you have an opportunity to do that. Maybe it's just free for all parking, but the owners decide to block off some units for preferred parking, like a unit right in front of each a space right in front of each unit, and charge $20-$25 a month for preferred parking. Or maybe they're putting up carports, so that's what their preferred parking is spaces that are under a carport for, they're in Vegas area, for example, to keep your car out of the sun, or in the Dallas-Fort Worth area where Brett is, to protect it in case of hailstorms and stuff like that. So yeah, any number of things that can be done here to increase the other income streams. Although the other income is always a smaller portion compared to the rental income. So what you can do with your rental income is definitely outweighs what you can do with your other income. But it can be an easier lever to use.
And these other income streams are going to depend on what class of property you're buying too. If you're in an older 1960s property, C-class property, other income is going to be a little bit different than maybe an A-class where they have like valet trash you can charge an upcharge for, or smart locks, that kind of stuff. So it's just going to depend on what property you buy to what other income you can apply to those tenants.
Exactly. So anyone else here on the call who has been invested, whether actively or passively, and you're just familiar with the business plan, have seen some different tricks that have been used with other income before that you want to share? Yeah, I'm gonna call someone out. Okay, if you're hiding from us, we're gonna start calling you out. I swear. I see Monica Cordell on the call right there. I know she's an active investor. Monica, do you mind? Do you have the ability to unmute yourself real quick? Best if you come on camera too.
Hey, how you doing?
Good. How are you, Monica?
I was gonna hide out. Let's see. I came on to support y'all. The one thing I think that really that I've seen sometimes with some business plans is make sure that the other income and the value adds are appropriate for the property.
Yeah.
I had, one group of agents that I've tried to work with for quite some time that had a little tiny C-class property that I was just looking at because it was just because of what it was, right? But it was what it was. It was definitely a hardcore C-class property, and it had its attributes, which is why I was considering it. But they were trying to push in the OM, they were trying to push valet trash. I'm like,
Right.
okay,
Yeah.
I'm going to be happy with these guys if they just put their trash in the dumpster. It just wasn't the right demographic to try to expect somebody, expect that demographic on that type of property, that class of property to pay for that extra feature, because that just wasn't, going to be something that was realistic. So I think it's really important to, when you're looking, not just do the cookie cutter other income value adds. There's a great list to draw from, but make sure it's appropriate for the property, that matches up, so you don't get into the property and then suddenly you can't fulfill the business plan because the expectations just weren't realistic, to match. It's like not over improving a property, right? You need to make sure that stays at a healthy balance and is actually doable.
Right.
Yeah, that's a great point, Monica. That reminds me of when Brett and JJ and I bought our property in Fort Worth, and it's a late 1960s C-class property. It's a nice property, but it's still C-class for sure. And someone asked me, but hey, what about the idea of putting in like an electric vehicle supercharger station there on the property. I'm like, no, I don't think you're not going to see one electric vehicle on this property at all. So much less
No.
enough to warrant a supercharging station. So
I always tell, like, when I flip, when I flip houses, I always tell people, a good flip doesn't have to be all marble columns and granite, and
yeah,
such. That's, it doesn't mean it's not a good property just because it's a C class, or that
Right.
it's not bright and shiny as fancy as maybe a B or an A. So it's just really important that business plan actually is relative and is a service to your residents, because you want to look for things that are valuable for them, that you can, that you will improve the property and improve their lifestyle being at your property. So that's, sometimes you have to, you can get a little creative, because different things are important to different people. So
Right.
exactly.
You know, so many good points there, Monica. And I think one of the big things that we can focus on, and that I personally we can talk about, because we've gone from good to bad, and I know Monica, you can speak on this too, that one of the most important assets that you can have in your team is the on-site manager, and having the ability to do a lot of what you're seeing on the screen right now. That is mainly due to the fact that you have one that's pushing these other incomes, and knowing what it is that, like those things that Monica had mentioned there, what is it that your tenant base is requesting, and making sure that you're tweaking your plan to give them what they need instead of what we think they need. Over.
Yep.
Did you just say
Sounds
over
good.
again, Brett?
That military coming out of me, sorry.
Military, I thought you were in the Air Force, man. Come on.
Man, got too many Marines on this call. I got to be careful.
Well, one other thing that's not on the screen right now is I'd like to mention too is utilities. So back when I first got started, it was a little bit more common, and it depends on the market you're in. You're looking in. It was more common to see some some properties that were all bills paid. Maybe they were master metered or whatnot, but either way, it was more common to see some all bills paid properties. And these days, most markets are getting less and less away from that, and they're charging the tenants for a portion of the utilities. Now, you can't make a profit on that, but you can at least offset the majority of your actual expenses for utilities by doing that. Of course, you can't do that if that's not what's common in the market, and you can't do that. You can't charge too much more than what your comps are charging. So there's a lot of understanding and evaluation that goes into what you actually put into that. But if you find a property that is, and this is something we did on, I believe, is our very first property. The seller had actually implemented utility charges, which is, you often hear it called RUBS, RUBS, and it's just an acronym that stands for Ratio Utility Billing Service. So the seller was the one that implemented RUBS after it had been an all bills paid property, and they were charging a very low amount, like $25-$30 a unit. This is back in 2016 in the Phoenix area. And so we were able to, and not everyone was on it yet either. So we were able to first get 100% of the property paying those charges, and then start slowly increasing those over the 2.5 years that we owned that property, until we had the 2 bedrooms paying, I want to say $45 a month, and the 3 bedrooms paying $55 a month, if I remember right, from several years ago, because we sold that in 2019. So.
Hey, Greg, can you hear me?
Sure can.
All right. Sorry, my mic wasn't working earlier. I own a little property in Tucson. I have it managed by a company, and they have a service that help the tenant when they move in if they don't have the full security deposit. They use a third-party company that would insure the landlord the security deposit. Is that something you've heard of, or can be like something that could be added like that to?
Yeah, I think you're probably talking. There's a service called Rhino, and there's a couple others that are
Correct.
similar
Yeah.
to it. Yeah, I think
And
that's what
it's
you're talking
different
about.
from rental insurance, so that's different. Some people get
Yeah.
confused.
Yeah, no, you're totally right, Nash. So So Rhino, what it is, it's not rental insurance, it's security deposit insurance in lieu of a security deposit. So in lieu of a security deposit, the tenant can contract with Rhino, pay them a monthly premium. And when they do that, if something happens where they have to move out early or they skip out, or whatnot, then Rhino pays the property owner one, 2, or 3 months worth of their rent. And that kind of depends on what the property is signed up for in the first place. So the property has to sign up, and then the tenants have to sign up. I've had varying degrees of success with that. So some properties it's worked better, some properties it hasn't worked as well. One thing that has been an issue, it was tenants who had no credit history or very little credit history. Generally, the price that Rhino gave them was so high that it was completely impossible for them to actually do that, and we still had to take a security deposit, a traditional security deposit, in lieu of doing that. So that was our experience. Not for every tenant, but sometimes it works better. Sometimes it doesn't work as well, depending on the property and the market. Monica, I see your hand up. Were you going to chime in on that topic also, or is it something different? Something different.
Well, it's just a quick point before that regarding all bills paid, especially with
Okay.
older C-class properties. Be really careful too. It's important to be really careful too when you're marketing your rents, because the general public doesn't know all the bells and whistles like we do. So if you're doing an all bills paid property, your rent may be higher than somebody doing a not all bills paid, and doing rubs. And then you just have to make sure that trying to explain that in a marketing message, you don't want somebody to skip over you because your rent is higher, but not realizing that includes all utilities. And it can be a great benefit to the residents. But again, it comes to catering, to your demographic, and really communicating well and being aware of how your competitors in the neighborhood are marketing their properties so that you get a true apples to apples, rather than having missing clients because they may not understand the difference in having apples versus oranges. And things like the Rhino program, with offering programs that they have options for security deposits, that can be a great selling point for residents coming in. So just be sure to clearly communicate that in the marketing, rather than just the standard rent.com stuff of here's your rent, because if you don't want to lose people not realizing what they actually get coming to your property.
Yeah, that's a fantastic point, Monica. Thanks for mentioning that. Nash, was there anything else? Did that answer your question about that, or is there anything else you?
No, yeah, no, I figured, that particular vendor, Rhino, that it will help, the property owner, increase the NOI by limiting bad debt, and also point of entry. People don't have a lot of money coming in. That was just an option to get them in, if they qualify. I just didn't know behind the application they will have to have certain credit, and that makes sense,
Yeah, there's a couple other tools that I've become familiar with, a little bit familiar, not enough to say for sure it works. I haven't used them yet. I've got a couple properties going to a tool called Flex. I'm going to drop a link to their website in the chat right now. What Flex is, especially if you're in a C-class property, you will see some tenants who are living paycheck to paycheck, who they have a hard time coming up with a rent on, by the first of the month, the entire amount they have. They try to pay a portion of the first paycheck of the month and a portion of the second paycheck of the month. So with Flex, this is something that if the property signs up for it, then the tenants can sign up for it. It costs them 15 or 16 bucks a month. But basically, they pay the first half, in the first couple of days of the month of their rent, and Flex pays the property the balance, and then the tenant pays them back on their next paycheck. And again, it costs them 15, 16 bucks a month. There's no charge to the property itself. And now that's not an other income charge for, like on the screen here. But it front loads your income at the start of the month, which helps with making sure you can cover your debt service and everything like that. The other thing is something similar that I haven't tried yet, but this came up on a call with a new property manager today. It's called Snap It. And what this is an AI system that helps detect document fraud. I don't know if people are aware of this, because most people who are going to be on this call aren't the type of people who would do this, but there are people who have Facebook groups, people who get paid money for putting out videos on YouTube as influencers, who what they do is they tell people how to defraud their landlords. How they can forge documents in a way that won't get caught, so that they can, and they're getting pretty darn sophisticated. And so this tool, Snap It, is an AI system that you can run all your documents through as part of the screening process. And their claim is they have 99.8% accuracy in detecting fraudulent documents. So, in my opinion, the best way to minimize your bad debt in your write-offs, delinquencies, to make sure that doesn't happen in the first place. And that starts off with making sure that all your tenants are actually qualified. Part of this on the property manager to make sure they're verifying all the documents. They shouldn't just be accepting the documents and pay stubs and everything like that at face value. They should be, hey, here's a novel idea, calling the employer and verifying they actually work there, and verifying their pay amount. And it's funny, I think, how many people these days are not doing the simple stuff like that. But either way, this can go along with that to help detect attempts to defraud properties, so that you can nip the bad debt in the bud before it even happens.
And to piggyback on that a little bit more, some of the things that we do as a team is no kidding. Obviously, the tenant screening is the most important up front. But after that, it's all about taking care of and ensuring that you are doing things that are community builders. And some of the things that our team have done recently is go down and, no kidding, let them see we're the owners here. We are out here putting landscaping up. We're picking up around the actual property. It's a family event. So we bring our family and get them involved as well and show them like what it is. We hold barbecues for our tenants. So those are some of the things that now when you start charging these extra fees, they're okay with that. Or you're increasing the rents, they're okay with that because they're getting taken care of. And that's what we love. I love that about this business. It's more of a service that you can provide in many different avenues.
Yeah, that's right. We're not just trying
to. I didn't say over there either.
Didn't say over. Yeah, that's right. We're not just trying to make money here. We that's part of the process, but we're trying to provide a service and give people a good quality living experience for the money they're paying. So absolutely. Okay, I'm gonna move on here and really, Nash, this is, I think, more the slide that speaks to what you were asking about before, which is ways to optimize income. So obviously, increasing occupancy increases your income. If you do raise rents, that is a way, whether it's just raising rents or whether you are improving unit interiors, you're renovating unit interiors to give them a more quality living experience, and so you can charge a premium for those units through unit renovations. Okay, those are a couple different ways to optimize income. Work you can do to decrease your bad debt, like we were just talking about, whether that be on the front end or midway. Those are all things that you can do to that help maximize your income. And then those using those other income line items as levers also, as you're able to in a fair and consistent manner in the market. Those are all things you can do to increase the property's income. So any questions or any more comments on this slide? All right, moving on. So besides increasing the income, you can also increase the NOI by reducing your expenses. Sometimes the expenses can't be reduced too much, but there are definitely things you can do to control them. So these are what you see on the screen there is the general different categories of expenses that you see, of operating expenses that you see in an apartment building. So I'm not going to read them off there, but certainly there's different things you can do. You can at least once a year, you should be bidding out vendors for different things and seeing if there's a better deal you can get. If there's ways to save money. We just switched on our Fort Worth property over to a new garbage provider that limits the annual cost increases and provides a better service. At least that's their claim so far. Still, they're just starting this past month, so we're waiting to make sure and see if the proof is in the pudding, you know. So
And we did a utility audit as well, and they found
Yep.
$1,900 worth of overage and taxes that we got reimbursed for as well. So sometimes it's good to do that and see if they can save you some money on your utility side.
Exactly. Depending on the size of the property and the location the property is in, marketing is going to look different. But it's important that the asset manager have a good feel for the marketing streams you're paying for, and don't let the property management company totally drive the train when it comes to that. Understand what it all costs and be looking at your monthly leads, and once in a while you should be turning that into calculating how much am I spending per month on marketing, what's my average number of leads this is driving, what are the marketing channels that are providing the most leads, what are the ones that are the most expensive, are they worth it, is there a marketing channel I should cut off and maybe adopt something different, or double down on one of them. What's my overall marketing spend per lead? How's this all boiling out? So a lot of ways to analyze that. Can get pretty in depth to make sure that you're getting your best bang for your buck there. Contract services, that's stuff like your landscaping contract, contract, stuff like that, pest control. What's been kicking everyone's butts lately the past couple of years has been this one right here, insurance. Insurance has just been bad all over the country. It's been worse in some areas, especially down there on the Gulf Coast, than others. That's one reason I like investing in Arizona a lot, for example, because insurance is a heck of a lot lower because they just don't have any natural disasters. Property tax is another one that's not quite the same, but it can be. Some states are more onerous on their property taxes than others. Arizona, again, is one of those states that doesn't have bad property taxes. The property taxes are not reassessed upon sale like they are in some states, and the property tax growth is capped at 5% per year. So that's leads to a lot lower expense to operating income ratios in Arizona compared to some other states. I was surprised to see Colorado is pretty much like Arizona in that regard too. Even though our insurance is a little higher there, we're running like around a 32% expense to income ratio on my Colorado property. So, yeah.
Greg, can you go into a little bit on the protest, on how we were able to actually win that and get the property taxes back? Can you talk a little bit about that?
Yeah, sure. And JJ, feel free to chime in too, man, because you handled that more than I did. But in some states, like Texas, for example, Texas has no state income taxes, so they are very aggressive in the property taxes. So you pretty much have to do a legal protest of your taxes every single year. And people think about that for their single family homes, but and it might be surprised to learn that, yeah, you have to do that for commercial properties as well. And I think we did that last year, and I think we saved like $45,000 off the top of my head. Now that has a certain cost. But the cost was, I don't know, $15,000 maybe. So there's a lot more savings than expense. Also, that savings came off of our property tax line item, which is above the NOI. So that affects our value. So that reduced our overall expenses for the year, which increases our NOI for the year, which increases our value. But that the legal bill for the property tax protest, that was a non-operating expense. So that was below the NOI. So that doesn't affect our property value. So all told, we improved our cash flow, and we improved our property value by protesting our taxes and successfully.
It was a win-win situation, basically.
Yeah, absolutely. But in Texas, that's just a way of life. You protest your property taxes every single year. And that makes being a property tax protest attorney a pretty lucrative career there. Okay, moving on. So we're almost done here, and this is now getting, everything before now was talking about the cash flow. Now we're talking about the appreciation potential. And I guess what I was just saying at the very end there about the property tax protest, how the cost of it is below the line, but the savings is above the line. And when I say, when I say the line, I'm talking about above the NOI or below the NOI. If you save above the NOI, that increases your NOI, and which means higher property value. Anything that goes below the NOI is a non-operating expense, does not affect your property value whatsoever. So I was starting to touch on that a little bit there too, but a couple things here. Obviously, Brett, you came up with these bullets. I don't know. Now these bullets are kind of jumping out at me and like, wait a second, because the ways to actually appreciate the property. So I guess some of this goes to value add projects that you can do, unit renovations, adding amenities on the property, especially something that is a direct profit center on the property, whether it be other income or whatnot. All those things are ways to grow the value and appreciate the property value overall. Is that what you're getting at here, Brett?
Bottom line is we're trying to increase the operating revenues and decrease expenses, and that's what we're saying right here. We just talked a lot about that previously, is just what are the things that we can do in this property to increase the value significantly, and that's what we're trying to do. Get the biggest bang, biggest juice for each squeeze, right? And so we are only going to do that, and we set that up in a business plan prior to actually going under contract, so that we know exactly how much value we can push into the asset before we actually get it under contract. So that way we can go and get on a webinar and teach our sophisticated and our accredited investors, so that they know exactly what problem we're trying to solve. That's the bottom line here.
So when we're buying these multifamily properties, when we're doing our due diligence period, we're going through and we're seeing how many of the units need to be renovated, how our classic units, and then how many of the units have been premium units of what the current sellers of the property has already done, and they're already getting full market rents. So if you got a 100-unit property and 50 of them need to be renovated, we know that we can increase the value by renovating those 50 units to bring it up to full market rent or above market rent, and that'll increase the value of your property. So that's what we're doing on the smart upgrades and increasing the value.
Exactly. We go ahead and move on because we're already at an hour and want to respect everyone's time. This is the last major slide on this. So obviously the cash flow and the appreciation are the two main methods where the property makes money. But the investors could also make money based off of indirectly through tax savings, property tax savings, and that's where the depreciation comes in. Bottom line is that the sponsors on the property, the lead general partners, can do a cost segregation study, which allows you to use what's called accelerated depreciation. It's a way that you can take more depreciation quicker on the property. Now, if whatever depreciation you take in the property, you do get hit with recapture at the end. But that's a complicated topic also, and more complicated than I want to go into right here. So suffice to say that you don't get taxed based on a single property. You get taxed based on everything that happens to you within that tax year. So there's other things, if you're going to get hit with a tax that year on a property that sells, that you can do to generate more depreciation to offset those taxes. So that you won't have to get hit with as much of a bill that year. So depreciation is a magical thing for investors. It really, really is. And if you have the real estate professional tax status, then any type of loss, whether it be ordinary income, capital gains, passive income, can offset any type of income. But for those of us who do not have real estate professional tax status, then a passive loss can only offset a passive income. It can't offset ordinary income from your W-2 job. And if anyone wants to learn a little bit more about that, reach out to us. We have videos and blog posts about that can explain it in a little bit more detail than we're going to go into right now. Brett, you look like you're talking, but you're muted.
No, especially right here. I know we're in the sensitive of time right now, but
Yeah.
A lot of our larger investors, this is the slide they love, because some of them are qualified in the real estate professional status and they don't even know it. Some of them own short-term rentals and they're managing something, a real estate asset they didn't even know. Some of them are managing the asset they're working in as an attorney. They didn't know that they would qualify. And so we teach them, like, hey, the accelerated depreciation, this is how much cost savings you can get if you invest in our deal. This is from day one, this is what you're going to get this year. And so that's the value of this, is that those larger investors that are getting hammered by taxes, and this is where they enjoy coming in as an LP into a lot of our deals. So that's all I wanted to say on that, Greg.
Okay, fantastic. Fantastic. That was the last slide for our main presentation. We did want to just put a quick plug in, mention this property that we are still raising capital for right now. This property is in Tucson, Arizona, 94 units. We're going to be closing in 2 weeks, actually. The raise is mostly finished. We have definitely enough to close and to start off our capital expense plan, but we're still finalizing the capital expense budget right now, capital improvement budget. So you can see what the returns are here on this. And this is our original projections. I think that very likely we're going to surpass this. These are still our official projections, but it's very likely, from what I've seen now, especially throughout due diligence, everything that's happened on the property, that we are going to be able to outperform these returns. So the two big benefits on this property is, one, we're getting it at a really low cost basis. It was under contract a little over a year ago for $19 million, and it fell out because the rates were still rising and the buyer lost their lender, so it had to go back in the market. And we got it for $13.6 million, and then got another $250,000 concession off of that during due diligence. So we got a 30% discount right off the bat. Why were we able to do that? Why didn't they just hold out for something better? Well, because the sellers are having a partnership divorce, and they just want to be rid of the darn thing. And they bought it at a really low basis to begin with, so they're still making money either way. So there's that. And then the other piece on this is this opportunity to add 17 more units. So the unit mix is mostly 2s, 3s, and 4s, very few 1-bedrooms. And there's 17 4-bedroom, 2 baths on the property that can be split, each of them, into a 2-bedroom, 1 bath and a 1-bedroom, 1 bath. The seller has already proven this out on 1 unit, so there's 17 more to go. So we're going to be able to add 17 more units to this. Should generate roughly a little over $90,000 a year in additional rental income. I'm sorry, $90,000. A year in net rental income. Which will add, off the top of my head, I believe is about $1.5 million in property value just there. So this is going to be a real strong property. We're closing in 2 weeks. We had a kickoff call with our property management company this morning, and we're ready to get going. JJ and I are the lead asset managers on this property, and there'll be 2 others helping us out in terms of one apprentice property asset manager, and then someone else helping out for the construction CapEx side of things. So if anyone is interested in taking a look at this, reach out to us separately, please, and we'd be happy to show you some more information about the property.
And that's, Greg, went back on, and when you initially started the conversation, is, hey, what are some of the things you're doing to add significant value up front? And that's, Greg just mentioned right there, that's dividing these 4-bedroom units into those smaller units and then being able to increase the rents immediately. And it's already being done. And so it's not like the risk is significantly high on this. We already know it can be done. And so that's the types of things that we love to do right off the bat, and our investors require that, or they won't invest with us. So these are the types of deals, the only type of deals that we're going to get into is something that's going to add significant value from day one.
Yeah, exactly. Exactly. That's a great point, Brett. Thanks for mentioning that. Okay. Next, this is, I think, the next to last slide. I just want to ask for people's opinions. These are a few of the potential topics that we are considering for the next few months worth of these events. Next month, actually, it'll be the announcements on the next slide, but next month is going to be about multifamily lending, or really commercial property lending. But here's a couple of other potential topics we've developed. But would love to hear your feedback. Is there anything that you're looking to learn about, whether it's multifamily specifically or just commercial properties in general, and investing in these types of deals? Any particular topics you'd love to see?
Jason said managing multifamily, so that's a good one.
Managing, okay. But how do you mean about that, Jason? You want to elaborate a bit on that?
Yeah, whatever the topic is in general.
Okay. Oh, okay, that topic one. I see. Okay, you're talking about the one that's on the screen. Okay, fantastic. All right.
Awesome.
Anyone else? Anything you're looking for in particular?
Did you mention the financing piece on the multifamily?
Yeah, that's actually going to be next month, which is our last slide. So next month is going to be basics of commercial lending. We're going to have a special guest
Okay.
helping present this. She is a loan officer with Old Capital Lending, Julie Peterson. She was my partner for a meetup in San Diego County until about a year ago, and we shut it down. But she lives in the San Diego area, Carlsbad to be specific. And she is known as the First Lady of Lending. So she's a fantastic, phenomenal person. So we're really excited to have her on there. So next session is Wednesday, June 19th. If you have your phone handy and want to scan this, you can go ahead and register right now. But of course, we will send that out as it gets closer as well. We didn't explain at the very beginning, but just so people aren't confused, this is the registration link. These QR codes down here are to each of our particular websites. That said, I think everyone on the call here are already connected with us. So that's, I'd focus on the registration.
Yeah, Greg, I do want to throw something out there right there. We have a great partnership with Old Capital, and if you guys haven't heard or gotten on their podcast, Old Capital's podcast, James Ing is just a phenomenal resource as well. So they're out there. They provide great content. We're so blessed to have Old Capital as a partnership.
Yeah, thanks for mentioning that, Brett. That's a great point and a really good tip, because they do have a phenomenal podcast. And when I was first getting into all this stuff, that was a regular was listening to the Old Capital podcast when I was driving on the weekend to go skydive. I had an hour-long drive, and I'd listen to a podcast or two every time on the way there. Learned a lot that way. So absolutely.
Awesome. Is there any other questions anybody has before we get off?
Hey, thanks everyone for joining this evening. Looking forward to next month's special guest and Julie, and then getting more throughout the month. If there's any questions or whatnot, feel free to reach out. And we're more than happy to jump on a call and discuss further. Thank you all.
Yeah, thanks for attending, guys. If you have, in the meantime, if you have any feedback for us on, or think of any other topics you'd like to see on a future version of this, reach out to us, let us know. Also, if you were interested in taking a little bit harder look at Midtown on First in Tucson, feel free to reach out to us for that as well. But other than that, thanks for joining us, and have a blessed month.
Thanks a lot.
All right, all right, fantastic. JJ, you guys have a good rest of your night.
Thanks a lot.
All right, bye all.